Hello and welcome. Today we're digging into a pretty bold financial forecast, one that argues we are right on the edge of a massive market storm. It's definitely a contrarian view, and we're going to break down all the key arguments straight from the source.
All right, let's just jump right in with that quote. That is a huge statement right out of the gate, and it really sets the tone for this whole analysis. So what exactly is being called a bubble here? Let's find out.
So in our first section, we're going to break down exactly what the source means by a bubble. And, it's probably not what you think. It points to some of the absolute biggest names in the market right now. Now, this is what's so interesting about this definition. The source isn't talking about failed, worthless companies. No, it argues that even a fantastic, innovative, and profitable company like Nvidia can become a bubble. How? When the market's optimism becomes so extreme, so excessive, that its price just completely detaches from any kind of reasonable reality. And this comparison here, it's a perfect example of the source's point, this time focused on Bitcoin. The argument is that its whole original purpose, this rebellious, anti-system currency, has been totally left behind. Now it's been repackaged as just another speculative asset, driven more by hype and price action than its actual founding ideas. And speaking of the source, the original creator includes a direct message that we're passing along. Please don't forget to subscribe, turn on notifications, share, and like. And right after that, a super important disclaimer that we have to echo. This is not investment advice. So just a reminder, everything we're talking about is for informational purposes only.
So, how does a bubble like this pop? Well, every bubble needs a pin, right? And according to our source, there are two huge potential triggers, one global and one much closer to home, that could set off a massive chain reaction.
Okay, so the first trigger is this kind of complex thing called the Japanese yen carry trade. But to put it simply, it's a giant global bet. See, investors borrow money super cheaply in Japan, and then they use it to buy higher yielding stuff all over the world, like US stocks. The danger, our source warns, is that if the Japanese yen suddenly gets stronger, all those investors would have to rush to sell their global assets to pay back their loans. That could kick off a fire sale across the entire globe, and that's why it matters. A global sell-off affects everybody. Now, the second trigger, this one is right here at home. The source is pointing to data that suggests the American consumer, the engine of the whole US economy, is actually in a historically weak spot. And you can see it right here on this chart. Our current confidence levels are basically the same as the absolute lows of the 2009 crisis, a world away from where we were before the pandemic. So the crucial point is this number, 51.0. Think about that. While the stock market might be roaring and hitting new highs, the confidence of the average person is at a level we literally haven't seen since the bottom of the Great Recession. That is a massive, massive disconnect.
And this is where it gets really interesting, because this consumer weakness, it's just one piece of a much bigger puzzle, what the source calls an economy of illusions, a huge gap between the story we're being told and what's actually happening on the ground.
This quote just perfectly captures the whole idea. The source is basically claiming that this narrative of a super strong, booming economy is, well, a myth. They're drawing a direct parallel between right now and the dot-com bubble back in 2000, right before the whole thing came crashing down. This table here breaks down what the source calls the stagflationary squeeze, and it's pretty clear. Basically, people are getting squeezed from every direction. Real wages aren't keeping up with inflation, so their income is actually shrinking. Costs are still high, their confidence is tanking, and now job security is starting to look a little shaky. It's a really tough economic mix. Okay, so after painting this pretty bleak picture of bubbles and economic weakness, the source material pivots. It turns to its proposed solution, which is a flight to safety, a flight to real, tangible assets. This right here is the core of the argument. Just let that sink in for a second. Unlike a stock, or a bond, or even the cash sitting in your bank, physical gold isn't a promise from someone else. Its value doesn't depend on a company's profits or a government's ability to pay its debts. It just is. And it's not just individuals thinking this way. The source makes a huge point that central banks all over the world are buying gold like crazy. And why? Well, the freezing of Russia's foreign reserves was a massive wake-up call. It showed everyone that in a geopolitical fight, financial assets can be weaponized, they can be frozen. But physical gold that you hold in your own vault, that has no counterparty risk. No one can just flip a switch and make it disappear.
And this same logic, this same thinking, is extended to silver. The source points to what it calls a severe physical shortage. We're seeing stockpiles at major global exchanges just draining away at an incredible rate. And the argument is that this kind of fundamental imbalance between supply and demand could have a really dramatic impact on its price down the road.
And all of this brings us to our final question, which really just sums up the core theme of this entire analysis. In a financial system that's built more and more on promises, on debt, on digital entries in a ledger, what is the true value of something real, something you can actually hold in your hand? Definitely something to think about. Thanks for tuning in.